Imagine two different retirees, right? They both start with $1.5 million in their investment accounts.
Okay, that's a pretty solid starting point.
Yeah, and they both take the exact same withdrawals over a 25-year period just to cover, regular living expenses.
Right.
And they even get the exact same 7% average return on their investments over that whole time frame.
Which sounds like they should end up in the exact same spot.
You would think so.
Yeah.
But here's the crazy part. One of them dies a millionaire, leaving almost $3 million to their kids, and the other goes completely broke by year 19.
Wow. So same starting balance, same lifestyle spending, same average return.
Exactly the same.
The only difference is the calendar, like the actual sequence of when the market went up or down.
Exactly. Welcome to the Deep Dive. Today, we're building a shortcut to a stress-free, tax-efficient retirement for you.
It's a big promise, but we've got the data to back it up.
We really do. We've gathered this massive stack of sources for you. We're looking at financial advisory guides from Savvy, ARQ Wealth, Mariner Wealth Advisors, plus this really heavy-hitting quantitative critique from Portfolio Metrics.
Yeah, that one is fascinating.
And we even have a real-world bear market diary from a retiree who writes over at the Retirement Manifesto. So our mission today is to unpack the famous three-bucket strategy.
Right, the ultimate never run out of money strategy. We are going to demystify the tax implications for every phase of your life, figure out if this is mathematically sound or, and this is the controversial part, if it's just a really brilliant psychological trick.
Yeah, I love that part. But let's start with that terrifying opening scenario. Before we talk about where you should put your money, we really have to understand the biggest threat to your retirement savings.
The whole reason this bucket strategy even exists.
Right. It's called sequence of returns risk. And the guide from Mariner Wealth Advisors lays this out so clearly.
Yeah, let's break down those two hypothetical retirees. We can just call them Portfolio A and Portfolio B. So on paper, they look like identical twins.
Right, the 1.5 million.
Exactly. But the timing of when they hit market crashes changes literally everything. So Portfolio A gets super unlucky and hits 4 years of negative 10% returns right at the very beginning of their retirement.
Ouch.
Yeah. I mean, after that, the market recovers and goes on a massive bull run. But because they were forced to withdraw money to, buy groceries and pay the mortgage while the portfolio was crashed.
They were selling shares when they were cheap.
Exactly. They permanently depleted their shares. So even when the market bounced back, they didn't have enough shares left to capture the growth. Portfolio A runs out of money completely by year 19.
That is terrifying.
Mm-hmm.
Meanwhile, Portfolio B gets those exact same negative 10% returns, but at the end of their 25-year retirement instead of the beginning.
Right. And because their money had time to compound early on, without being drawn down during a crash, Portfolio B finishes the 25 years with nearly $3 million.
Same average return.
Wildly different outcomes. Sequence of returns risk proves that timing is everything. It's not about your average return, it's the specific order of those returns.
Okay, let's unpack this with a listener.
Yeah.
Because it's like, okay, sequence of returns risk is basically like hitting a massive pothole on a cross-country road trip.
I like that.
Right, like hitting it in your own driveway right as you leave ruins the entire trip. You're done.
Your axle is broken.
Exactly.
Yeah.
But if you hit that exact same pothole 2 blocks away from your final destination, it's just a bump. You still make it.
Yeah.
So how do these buckets, pave over the pothole?
Well, they do it through strict time segmentation.
Oh,
So
so-
according to ARQ Wealth and CTP Enterprises, you divide your money based entirely on when you actually need to spend it. So bucket 1 is your now bucket, or the short-term bucket. It holds 1 to 3 years of living expenses in pure liquid cash, or, cash equivalents like money market funds.
Stuff that doesn't lose value.
Right. Then bucket 2 is your soon bucket, or medium term. This is designed for years 4 through 10 of your retirement. And this one holds bonds and income-producing assets.
Okay, and then bucket 3.
Bucket 3 is your later bucket, or long term, year 10 and beyond. This is where you keep your growth equities, the stock market.
Got it.
And the mechanism here is what makes it work. By having 1 to 3 years of cash sitting in that now bucket, you completely insulate yourself from the sequence of returns risk.
Because if the stock market drops 20% the day after my retirement party, I just don't care.
Exactly. You do not have to sell your growth stocks while they're actively bleeding. You just live off the cash in bucket 1. It buys your stock portfolio up to 3 years of completely undisturbed time to recover.
So you never have to eat your seed crop. But having a timeline for your money is really only half the battle here, right? because the government has its own timeline.
Oh yeah, Uncle Sam always gets his due.
Always. So how do we map these time-based buckets to tax-based buckets so you don't end up losing a massive cut of your life savings to taxes?
So this is where the Savvy Guide comes in. They map out a tax diversification strategy that also uses 3 buckets but categorized by IRS rules.
Okay, lay them on me.
Bucket 1 is tax-free. These are your Roth accounts, Roth IRAs, Roth 401ks. You already paid income tax before the money went in, so everything it grows into and every withdrawal you make is completely tax-free, forever.
Which is amazing. And bucket 2.
Bucket 2 is tax-deferred. This is the traditional 401k or traditional IRA. You got a nice tax deduction when you put the money in during your working years.
Right, it lowered my tax bill back then.
Exactly. But when you pull it out in retirement, every single dollar is taxed as ordinary income.
Ouch, okay. And the third bucket?
The third is your taxable bucket. Just regular brokerage accounts. You pay taxes on capital gains and dividends as you go, but the perk is you can access the money at any age without any early withdrawal penalties.
Okay, so managing these tax buckets requires understanding a really critical forced mechanism, right? RMDs.
Yes. Required minimum distributions.
Because the government will not let you defer taxes in that middle bucket forever.
No, they want their money. Starting at age 73, the IRS actually forces you to start withdrawing a certain percentage from your tax-deferred accounts every year.
Even if I don't need the money to live on.
Even if you don't need a single dime, you are forced to take it, and you have to pay ordinary income taxes on those forced withdrawals. Though importantly, Roth accounts are exempt from this rule.
Okay, here's where it gets really interesting for you listening. Because if I only save in a traditional 401k my entire career, I'm basically building a massive tax time bomb that detonates on my 73rd birthday.
A huge time bomb.
Because I could be forced to pull out huge sums of money, which pushes me into a massive tax bracket. So how do I diffuse it?
You diffuse it through what Savvy calls dynamic withdrawals.
Dynamic withdrawals, okay.
Yeah, so the common advice you hear is just spend down your taxable accounts first, then tax-deferred, and save your tax-free Roth for last.
That's what I've always heard.
Right, but a dynamic approach looks for mathematical opportunities. So let's say you retire at 65, but your RMDs don't start until 73.
Okay, so I've got an 8-year gap.
Exactly. You have an 8-year window where your earned income from your job has completely stopped, meaning your tax bracket might suddenly be incredibly low.
Wait, but if I'm in a low tax bracket because I just retired, my instinct is just to enjoy the low tax bill. Why would I voluntarily move money around and trigger taxes?
Because it's about optimizing your lifetime tax bill, not just this year's bill. In that 8-year window, you do strategic Roth conversions.
Oh, I see.
Yeah, you intentionally move money from your traditional IRA to your Roth IRA. Yes, you pay a little bit of tax right now, but you're paying it at a historically low 12% or maybe 22% rate.
Which shrinks the size of the traditional account.
Exactly. It defuses the RMD time bomb before you hit 73, when forced withdrawals might have pushed you into a 32% bracket.
That makes total sense. And the sources point out it's not just about withdrawal order. It's about what specific investments you put in each account to begin with. Asset location.
Asset location is such a fascinating concept. It's not just how much you save, it's where it physically sits. So you want to place tax-inefficient assets inside your tax-advantaged accounts.
Give me an example of that.
Okay, take real estate investment trusts, REITs. By law, REITs are essentially forced to pay out the vast majority of their profits as dividends every single year.
Right.
So if you hold a REIT in a normal taxable brokerage account, you are getting taxed on those payouts annually. It creates this constant tax drag.
But if you put that REIT inside a Roth IRA,
then that heavy dividend hose is running completely tax-free.
wow.
Meanwhile, you place tax-efficient assets like broad market ETFs that just quietly grow without throwing off massive dividends.
We put those in the taxable bucket.
Exactly. It lowers your lifetime tax friction without changing your overall investment mix at all.
Okay, but diffusing that tax bomb and setting up all these buckets, that takes decades of deliberate asset placement.
It really does. It's a lifelong process.
So let's build a roadmap for you listening right now. How you allocate your savings needs to look wildly different depending on your current age. So let's map this out decade by decade, starting with your 20s and 30s.
All right, 20s and 30s, this is your aggressive growth phase. The guidance across the board here is to focus heavily on the tax-free bucket, Roth contributions.
Because when you're young, you're likely in the lowest tax bracket of your entire career. So you pay the taxes now while they're cheap, put it in the Roth. and let the math do the heavy lifting. I mean, 4 decades of tax-free compound interest is literally the most powerful force in finance.
Absolutely. Then you hit your 40s. These are typically your peak earning years.
Yeah.
You're likely in a much higher tax bracket now.
Making good money?
Yeah, so this is when the math says you want to shift your focus to the tax-deferred bucket, the traditional 401k.
To get the upfront tax deduction.
Exactly. You want to lower your current taxable income right now when it's at its absolute highest.
And I just have to enthusiastically throw this in because it is the golden rule. No matter what age you are, always, always grab the full employer match on your 401k before you do anything else.
Oh, absolutely.
It is free money. 100% instant return. Never leave that on the table.
Could not agree more.
Yeah.
So moving into your 50s, this is the catch-up phase. The IRS recognizes you're nearing the end of your working years, so they literally allow you to make catch-up contributions.
They raise the legal limits on what you can put in.
Right, like letting you shovel an extra $7,500 a year into a 401k. And this is also the mathematical sweet spot for planning because your kids might be out of the house, your expenses might drop.
So you start heavily modeling those Roth conversions we talked about.
Exactly. You are preparing for the reality of your 60s.
Which brings us to your 60s.
Yeah.
You are nearing the finish line. And the sources suggest focusing on building up that accessible, taxable brokerage bucket.
Yeah, and the reason why is really practical. If you want to retire early, say at 62, you need a financial bridge. You can't touch Medicare until 65.
Right.
Full Social Security doesn't kick in until 67. And you might want to delay drawing down your traditional 401k to manage your taxes.
So that taxable brokerage account acts as a highly flexible bridge to get you across those gap years without triggering any early withdrawal penalties.
Exactly. But if I can connect this to the bigger picture real quick, these age-based allocations aren't fixed rules.
What do you mean?
Well, a financial life is dynamic, right? If you are in your 40s, supposed to be your peak earning years, but you decide to take a sabbatical.
Or start a business.
Right. And you expect a wildly fluctuating, temporarily low income year. The math dictates you pivot right back to heavy Roth contributions, regardless of your actual age.
Oh, that makes sense.
The strategy has to serve the reality of your income, not just your birth year.
Okay, so on paper, this all sounds bulletproof. The buckets are full, the tax locations are perfectly optimized, the decades are mapped out. But I have to ask, what happens when the ink dries, you actually retire, and the market immediately crashes?
'Cause it survived a real-world stress test.
Right. And this brings us to a really compelling piece of source material. We've got Fritz Gilbert, the author of the Retirement Manifesto.
Yes.
He retired 4 years ago, physically implemented this exact 3-bucket strategy you were talking about, and then ran headfirst into the brutal 2022 bear market.
Talk about bad sequence of returns, timing.
Seriously. And he kept a detailed diary of his financial moves, which addresses a huge question for investors.
Oh.
Are bonds still useful?
Because in his actual experience, conventional wisdom completely failed him.
It did. So what does this all mean? We're told bonds are the portfolio's shock absorbers, but he found out his shock absorbers were completely broken. Is the middle bucket actually a vulnerability?
It's a very valid concern because the traditional model says bucket 2, the soon bucket, should be filled with bonds because bonds are safe. They're supposed to go up or at least hold steady when stocks go down.
Right, they balance each other out.
Normally, yes. But in the recent bear market, that correlation broke completely. Short-term bond funds lost value at the exact same time stocks were crashing.
Why did it break?
Because of the Federal Reserve. To combat inflation, the Fed raised interest rates rapidly, and when interest rates go up, the value of existing bonds mathematically has to go down.
Seesaw.
Exactly. If you hold an older bond paying 2% interest, and suddenly brand new bonds are paying 5%, nobody is going to buy your 2% bond unless you sell it at a massive discount.
Wow. So both of his first 2 investing buckets were bleeding at the same time.
Right, which shows why the traditional 60-40 stock-to-bond ratio is under such immense pressure right now.
So how did he survive it?
He survived by leaning 100% on his 3-year cash buffer in bucket 1. He totally ignored the bond bucket. And to protect his cash, he switched to buying high-yield CD certificates of deposit, which were suddenly yielding like 4.7 to 4.9% guaranteed by the bank.
That is wild.
Yeah.
And he also used this brilliant mechanical maneuver he called the drip refill strategy.
Oh, I love the drip refill.
Right. So normally when your stocks pay dividends, you have a DRP, a dividend reinvestment plan, turned on. It automatically takes that cash dividend and buys fractional shares of more stock.
Which is great during a bull market.
But Fritz went into his account and actively turned the reinvestment off. Instead of buying more stock, he directed all those cash dividends to flow straight into his bucket 1 cash reserves.
It's such a smart move
Yeah.
because it mechanically slows your cash burn rate without you ever having to actively hit the sell button on your actual assets while they are down 20%.
It's a textbook execution of the bucket defense. He literally slept well at night because the cash was there. But, and this is where we really have to look at the other side of the coin.
On math side.
Yes, because he loved his cash buffer for the psychological safety, but at what hidden mathematical cost?
And this brings us to the massive quantitative critique from Portfolio Metrics.
Oh man, they do not pull their punches.
No, they don't. They basically argue that this entire bucket strategy is a suboptimal behavioral trick.
A suboptimal behavioral trick. They literally proved that the bucket strategy is mathematically inferior to a standard, strictly rebalanced portfolio.
And it comes down to a few very specific mechanical flaws. The first one is cash drag. If you hold 3 years of living expenses in cash, say $150,000 on a $1 million portfolio, that money is not growing.
Just sitting there.
Worse, it's actively losing purchasing power to inflation. Over a 30-year retirement, the compounding growth you sacrifice by sitting on that much cash is staggering.
It creates a massive drag on your total wealth,
Yeah.
but it gets worse than just cash drag.
Right. Oh, yeah. Portfolio Metrics points out this phenomenon called uprisking, and the math here is fascinating.
Lay it out.
Okay, let's say you retire with 20% of your money in cash and 80% in stocks. You spend your cash to live year after year, and you deliberately don't sell your stocks because you are following the bucket rules.
Okay, makes sense.
Well, mechanically, as the cash physically disappears from your total balance, your portfolio ratio drifts. It becomes 90% stocks, then 95% stocks.
Wait, really? So by doing absolutely nothing?
Your portfolio is mechanically becoming significantly more aggressive and risky as you get older.
That blew my mind when I read it. The whole point of the strategy is safety, but the mechanics actively push you into higher risk.
Exactly. And then there's the final nail in the mathematical coffin. The lost rebalance premium.
What's that?
In a standard portfolio, if stocks crash by 20%, a computer algorithm automatically rebalances you. It sells a portion of your safe assets and buys stocks while they are deeply on sale.
It forces you to buy low.
Exactly. But in a bucket strategy, you stubbornly refuse to touch your buckets. You just spend your cash and wait for the storm to pass, which means you completely lose out on the mathematical opportunity to buy assets when they are cheap.
So that's why Portfolio Metrics calls it a psychological flaw. Mental accounting, where we treat money differently just depending on what label or bucket we slap on it, even though mathematically a dollar is just a dollar.
Right. But, and this is where I get really excited about this nuance, Portfolio Metrics actually acknowledges exactly why human advisors use this strategy.
Because it works on humans.
Exactly. Because if a client physically understands the buckets, they don't panic and sell everything at the absolute bottom of the market.
So they propose a marriage of the two concepts.
Yes. The solution is to actually invest and strictly mathematically rebalance the portfolio behind the scenes. You capture all the growth, you avoid the cash drag, you get the rebalance premium,
Right.
but you report it to the client using bucket language. You frame the conversation around these safe buckets to manage their human emotion, while the optimal math works quietly in the dark.
I love this so much. It's exactly like sneaking vegetables into a kid's smoothie.
That's a great analogy.
Right. The spinach, which is the math, is in there doing all the heavy lifting for their long-term health. But the bucket story is the strawberry flavor that keeps the investor from throwing a tantrum and dumping the whole thing in the sink when the market drops.
The optimal math protects the money, but the story protects the investor from themselves.
All right, let's take a breath and just quickly recap this whole journey for you. We started by defining the enemy, the sequence of returns risk, where bad timing can wipe out your seed crop.
And we countered it with time-based buckets. Cash for now, bonds for soon, stocks for later.
Then we map those out to your tax-free, tax-deferred, and taxable accounts, showing you how to diffuse the RMD tax time bomb using dynamic Roth conversions.
We built a decade-by-decade game plan from your 20s all the way to your 60s.
We looked at a real-world bear market where bonds actually failed as shock absorbers because of rising interest rates. And finally, we exposed the psychological trickery of mental accounting, cash drag, and uprisking.
We covered a ton of ground today, really balancing the hard math with the messy realities of human emotion.
We did.
But I want to leave you with one final thought to mull over, something that looks beyond all these current strategies.
Okay, let's hear it.
So, Portfolio Metrics proved that mental accounting is just a mathematical flaw, right? But we are emotional creatures, not spreadsheets. So ask yourself, what if the best financial plan isn't the one that yields the absolute highest percentage return on paper, but the one that allows you to sleep so soundly you never feel the urge to panic check your brokerage account in the first place?
Wow. That is such a fascinating angle.
Yeah.
I mean, if the strawberry-flavored bucket story keeps you from ruining your own life savings, maybe the psychological trick is actually worth the mathematical cost.
Exactly.
Thank you so much for joining us on this deep dive. Keep exploring your own financial roadmap, and we will catch you next time.